to another session of the TokenizeThis conference. Hope everyone is enjoying all the great content from all our amazing speakers so far. We've heard from the liquidity problem, We've heard about Oasis Pro, our title sponsor, and now Blockstream as well. So a lot of good stuff going on from different angles. I'm Jason, your COO, and we are joined today in the Future of the Markets panel. This is a panel that we put together containing a variety and diversity of perspectives in the industry. We're joined by Tal Elyashiv, our managing partner at Spice VC, Scott Smiley, co-founder of HiYield, and Alan Qureshi, president of Blue Water FinTech. Gentlemen, how are you doing?
Good to be here. Thanks for having us, Jason.
Absolutely. Thanks for joining us. Awesome. Well, why don't we start with some introductions? Tell us a little bit about each of yourselves and what your company does and what its role is for this industry.
All right, so maybe I'll start. Tal Elyashiv, you mentioned that I'm the managing partner of Spice VC. It was founded in 2016, 2017. It's the first tokenized VC fund. And I'm also a co-founder of Securities, one of the major players in
this is our
space.
And
I've also, for the last 3 years, been publishing. I think I published over 100 articles, all related to blockchain and Web3. And you're the first to hear that I'm launching a book exactly a month from now in the Digital Asset Week in London. So I'm knee-deep in tokenization and blockchain since 2016.
All right, I guess I'll go next. So I'm Scott Smiley. I'm co-founder of HiYield. Before I got into the crypto space, I worked in traditional finance. I worked on asset-backed securities specifically at Deutsche Bank, and then started to get into blockchain and cryptocurrency in early 2017, and haven't looked back since. I spent the majority of my career in the blockchain space working on a project called the Icon Project. I did token economics, governance, business development, and did a lot of product development there as well, working at the application layer of the Icon ecosystem, and have now since been branching out, trying to leverage my background and the background of my co-founders to build HiYield, which is providing infrastructure for on-chain capital markets with a focus on lending and fixed income to get started.
Excellent. Hey, my name is Alan Qureshi. I'm the founder of Blue Water Financial Technologies. We are a FinTech platform that is primarily focused in the mortgage asset ecosystem. What that means is with our technology, we're able to deliver assets on-chain in a fractionalized form. And through our processes, we've been able to digitize the mortgage asset origination process here in the US with regard to pricing, trading, transferring, diligencing, and delivering assets and tracking those assets seamlessly through an all digital platform.
Fantastic. Well, thank you very much, everyone. This panel is called The Future of the Markets. But before we dive into the future, I do want to stress that, we've been around for, 5 years is, our birthday today, actually, at Security Token Market. And the industry has been around for a bit now, but it's still somewhat of a nascent industry. And nonetheless, we have seen some progress in those last 5 years that we've been tracking it. But, I want to hear your perspective, in those last 5 years, what are some of the top highlights in terms of, notable strides of progress in terms of the adoption of tokenized securities?
I think my domain is one of the first ones to have grown over those 5 years. Capital markets, more specifically the securities part. A lot of people were looking at adoption from the perspective of liquidity in the market. And I think that the expectation from blockchain to be the magic that will bring liquidity to private equity and to small private securities was not very realistic. I think that blockchain and tokenization has the possibility of providing more access to these and smoothing a little bit the transactions in those arenas, but this is not what creates the liquidity. But where everybody were looking at liquidity, what happened in the capital markets arena is that almost every major player today in capital markets is using blockchain one way or another for some parts of the process. And I think this is the big progress that we've seen. All the major players, incumbents and new players, are all using blockchain for simplification of some of the complexities in the process. And to me, this is a very exciting thing to look at, because it was part of our vision when we created Spice VC back then. But it also reinforces the expectation that 10, 15 years down the road, all financial assets will be riding on blockchain one way or another. It doesn't matter which blockchain, it doesn't matter which protocols, because these will change over the next 10, 15 years. What is important is that blockchain is going to be a key infrastructure behind the securities industry. And that means over $100 trillion worth of assets over blockchain one way or another. To me, this is the mega progress that we've seen over the last 5 years. We can look at small things, right? If you look at tokenization of financial assets, then initially it started with less interesting assets, and the result of that was almost no liquidity. But over the last couple of years, we started seeing mega players being interested in being tokenized. Hamilton funds have been tokenized. There's some other mega players in the
Franklin Templeton, right?
Yes, and that again is an indication that tokenization is not just the magic that will create liquidity. It really simplifies processes. It really solves a lot of problems in the securities arena. So I think this is probably one of the industries that have seen the most progress in that regard.
Yeah, no, definitely kind of, just to jump in there, definitely agree that, like liquidity isn't necessarily, like blockchain doesn't solve for liquidity. It's not just going to like bring money to a product that's like not interesting on its own right. That suddenly it's going to become more interesting and a better investment opportunity because settlement happens on chain. I think ultimately where the efficiencies come in is like more in the settlement process. And it like where we've seen a lot of growth over the last 5 years is through stablecoins. I think I know we're talking about securities and you specifically asked about securities, but stablecoins and, USDC are like kind of the first like tokenized RWA being dollars. And that was like the major form of, using blockchain to settle dollar transactions is certainly more efficient than traditional financial rails. And now with interest rates being higher, like storing assets on chain in stablecoins is becoming more costly. So now we're seeing more of a push to bring other assets that have the same settlement properties of USDC. So I think we start seeing like most of the stablecoin holdings start diminishing as the amount of tokenized traditional financial products increases and start using maybe bank deposits for settlement as opposed to specific, instead of like just USDC specifically or some kind of yield bearing stablecoin for settlement. And kind of, that's what I was looking at JP Morgan, their Onyx blockchain. They've been doing a lot of settlement of repo transactions as well using Onyx. So that's something that I think settlement processing of transactions, really the bank's middle office is where blockchain adds a lot of efficiencies. Oh, Alan, you're on mute. Love to hear what you have to say, though.
Thank you. Appreciate it. Yeah, I guess for my part, what I would say is that, listen, if I think of the developments that have happened over the past 5 years. I'm going to take a capital markets view of looking at this, and the shakeout and deleveraging that have happened with the functional equivalent of our Enron or our WorldCom with FTX, or even on the banking system with regard to SVB, and the move by investors to look at alternative ways to get access to assets, right? As one particular sort of watershed event, I actually think that shakeout has been good for the industry. I think that the potential for regulation is good for the industry. I think that having less hype and more focus on, as we're discussing right now, right, real world assets that provide real value and solve real capital needs and investment needs on the one hand, right? And that's what I think about with regard to people who want access to assets, right? So-called token investors. And then on the other side, people who need distribution and people who are looking to unlock. I think we started with, well, hey, liquidity is just a start. I think it's the other aspect, which is, okay, hey, great, like there's a pool of liquidity on the capital side, but what I've seen, certainly from my seat, particularly coming from the U.S. mortgage arena, where there is a fair amount of still processes being done manually, is this sort of parallelization of, on the one hand, token technology getting better and better, sort of democratizing and digitizing. And then on the other side, real world assets being made available in a form that's consumable for the other side of the coin. So I think it's sort of really, two things. The fact that, hey, a lot of the hype's being extracted and we're actually focusing on real world assets, that's a really good thing. And then the second piece is the fact that, quite frankly, a lot of these other sort of ancillary assets that are very, very interesting, that have very interesting yields, that are very deep and liquid, right? $14 trillion US mortgage market. That's a deep market, right? And the fact that technology is now catching up on both sides, I think that's highly positive and very accretive to tokenization just generally.
Awesome. You guys have a very interesting perspectives on this, actually. And we touched on multiple points, right? We talked about liquidity, operational efficiencies, democratization of the capital markets. On the liquidity side, it's, something that is still missing. And I do want to dive a little bit deeper into that. But on your other points about operational efficiencies and whatnot, I mean, it's things that we've been seeing, especially this year as things come out in terms of, what people are seeing, whether it's back and middle office, or simply other things that are just more, how do I say this, of an option. So for example, in the liquidity argument, a lot of people bring on is like, hey, I just want to tokenize an asset so I can trade it easily. As you guys mentioned, that does not bring liquidity just because it's represented by a token. What it does do, though, I think, is create liquidity optionality, as we like to call it, the option to be able to trade a little bit more efficiently in terms of the process of doing it, but not so much as in terms of like the amount that will go back and forth. Some assets are a little bit more liquid than others. As we know from the public markets, assets trade based on information, right? How much do I know about an asset, and do I have to be able to make an informed decision if I want to buy or sell it? Private assets are not necessarily obligated to report as much, and so as such, liquidity won't be there, or at least it'll be missing. But that may bring me to my next question, though, is the liquidity problem. I think we've all noticed that it's not there yet, not where we would like it to be. But what's it going to take? And are there different types of liquidity? Is it just trading, or are there other options that are considered liquidity?
First, let's talk about what is it going to take. So I think we touched on some things, right? Assets need to become more and more interesting, and tokenized, not because it's the only way, because you can't raise money any other way, but because you really want to make it more accessible, and the asset is very attractive as is. The second thing is they need to be big assets, right? If you tokenize a $10 million worth of an asset, there's not going to be liquidity, no matter what. There's nothing to do with tokenization. Assets that are very small will not see a lot of liquidity. If there is not a lot of change. It doesn't have to be volatility, but change, growth, whatever in a value of an asset. Again, you're not going to see a lot of liquidity because people buy and hold and nothing happens, right? And there are also assets that are financial assets that normally are treated more like OTC, not because there's no liquidity, but because people buy them in order to hold for a longer period of time. Venture capital is a good example. Private equity is a good example. So you have a bunch of private equity funds tokenized, and Spice as a venture capital fund is tokenized. But people invest in venture capital not in order to sell it a week later for 2% more. They buy it to hold on for the longer period of time, typically 5, 6, 7, 8 years. They want to know that liquidity is an option, but that's not why they're holding it. And therefore, you're not going to see a lot of transactions in the market. So you need to see more assets that are naturally more changing hands at a higher velocity in order to see more liquidity. But there's also another thing. The market started from the bottom rather than from the top. So not only small assets, but you have small portion that is being tokenized, and a lot of the exchanges, marketplaces for tokenized assets are not sharing order books. And there is no protocol in the industry at this point anyways for sharing order books. And what it means is instead of creating more liquidity, the more players there are, the more broken the liquidity is of an asset, if you will. And that will have to change. I think that players will have to come together and figure out that in order to create liquidity in a market that is growing from the bottom, you have to share order books and allow different players to fulfill an order or to create liquidity together.
Sure thing. And Tal, I'm glad you brought up, bringing on more assets that are probably more prone to tradability, to changing hands. You're an investor in this space. Your fund is tokenized. Tell us about what a future looks like of of having an existing portfolio that is tokenized, such as yours, and the individual portfolio companies also being tokenized. So what does that look like? What does a tokenized fund of tokenized products look like, or assets?
It's very interesting because our portfolio companies are not tokenized, right? The fund is tokenized, the portfolio is tokenized, but so the relationship between the fund and the LPs is what is being tokenized, but the investments are traditional investments in traditional equity in those companies, at least for the majority of the portfolio. But you're asking me about the future and about portfolio of tokenized companies. I don't see any difference because as a VC fund, you invest for the longer run. So the fact that a equity in a company is tokenized is a technicality. It's not really for the purpose of creating liquidity for us, anyways, because that's not our business model. It makes it easier to liquidate assets or liquidate portion of your portfolio, but that is less consistent with the way VCs work with portfolio companies and play a significant role in the growth of those companies over time. It definitely, I can tell you that tokenizing the relationship with LPs was the right thing to do from many perspectives. A typical VC fund usually has, 10, 20 LPs. Beyond that, it's getting really complicated to manage. We have 450 LPs and way less administrative burden than a traditional VC fund with 10th of this of LPs, and that's because the relationship is tokenized. And it really simplifies from a regulatory standpoint and also from a day-to-day standpoint, the whole management of the relationship with LPs. Right now, I don't see an immediate value for a VC for portfolio companies to be tokenized, but it's also not necessarily a bad thing.
Sure. Yeah. And look, to your point, a VC has a different investment strategy than, say, a hedge fund or just an individual investor. So you make a good point. Right? You have the relationship that's tokenized technically between your LPs and yourself. And then you also have potentially, just the ease of rebalancing a portfolio, maybe not as prominent for VCs, but for other investors, they may want to be more granular in terms of, how you rebalance that portfolio based on, whatever your underlying companies are doing. But I want to shift the conversation a little bit over to, a little bit away from the liquidity aspect. I think that's a lot of conversation we've talked about a lot, which is fantastic. But let's look at the other side of the coin that we explored earlier, which was the back and middle office. Alan, you're working with digital mortgages. Talk to us about how tokenization enhances mortgages in the back office or from the secondary market perspective.
Yeah, no, and what I would say is that it's needs driven, right? So the ultimate finished product has to be, and I think this dovetails, by the way, quite nicely with what Tal was talking about, which is embedded in all of this. For something to be on chain, it actually has to have some level of trust associated with it. It has to have some level of diligence associated with it. It has to have a degree of transparency around what is the thing that you're buying, right? So assuming that's the end goal, the front part of that, or all of the concurrent activities that lead up to good delivery, include asset verification, right? Price certainty, right? So, hey, I bought it at some price or some yield or some cash flow. What does that actually, how does that manifest itself in terms of the underlying assets? Have they been reviewed? Is that process also digital, right? We would hope that it is, so that everything that tokenization provides on the back end can be afforded on the front end. And when we think about that, when we think about something as archaic historically as has been mortgage, we start to think about the fact that we need an ecosystem to ingest all of those assets on the front end and make that very streamlined under this concept of delivering good product that has been reviewed. In our case, our processes are insured by certain underwriters of Lloyd's of London, right? So that means that not only are you getting interesting product at an interesting yield, but it's been reviewed, and that process itself is insured. So all of a sudden you're in a zone from a back office and ops perspective where the product that you're boarding on chain has very clear provenance, has very clear sightlines into what the asset quality actually is. And I think that's highly essential, going back to what Tal was talking about vis-a-vis trust and liquidity. Make sense?
Yes, and
Absolutely.
I would add to this, Alan, that one of the things that is still missing from the market is enough, I'll call it rating agencies, that rate assets and compare assets so people can look and find their value proposition and their parameters in the different assets that they're flipping through. Right now, it's almost non-existent, except security token market and maybe one more resource.
Well, and Tal, it's interesting you say that, right? When you think about your traditional kind of third-party rating firm, right? TPR firm, heretofore, pre-Blue Water, certainly in our zone, they might take 8 hours for a given loan file, right? Truly, 8 hours to review a loan file with offshore resources. And that's stare and compare, literally butts and seats, right? Think about how arcane that is in terms of where the final resting place of those assets are, right? So we spent a lot of time digitizing that process from end to end. And there is a question around what's been one of the hardest issues to solve. Well, that would be one of them, right? Creating that end-to-end ecosystem, that layer that goes all the way across. So ultimately, you're handing off a baton to the tokenization piece, right? Good delivery, trusted assets, right, that have been reviewed, as Tal would suggest. Yeah.
Yes, just a quick question for you, Alan. I actually just recently went through the property, purchasing property process. Didn't mean to create an alliteration there, but a lot of when I think about trying to create efficiencies in the market or in this transaction, I'd say it's maybe like a 2-month process. There's negotiation between the buyer and seller. I don't really see digitizing that. There's the legal contract of all the nuances of that individual deal. The seller is going to pay for this, the buyer is going to pay for that, negotiating all of these terms to come to a final price and who's paying what costs and, calculating my all-in costs that takes time. So I'm curious. And then, the legal review of both sides, right? Both sides need to have lawyers to make sure the contract actually reflects upon what was agreed. And then the final 3 days of the transaction is the actual settlement and signing of documents and things to that effect. So I'm curious to hear from you because from my perspective, I've been seeing a lot of people trying to bring efficiencies to the mortgage market. But then when I went through it myself, I was having a hard time thinking about how you can automate and digitize a lot of these steps that were actually the most cumbersome, difficult parts of the process.
Sure. So we primarily focus on the U.S. residential market, which for what we've built is an end-to-end process. You must just be exhausted having described all of that. That sounds like a lot. And listen, there are various aspects of the mortgage market, mortgage ecosystem, right? We started with mortgage servicing, which is a very interesting asset. It's negative duration, it's high yield, it's fractionalization ready, right? Wonderful. We built out a platform, pricing, trading, transfer, QC, due diligence, right? We started with MSR, right? What you're talking about to me sounds like a non-QM loan. Well, we've built, all of the secondary market capabilities from the front end all the way to the back, right? Back meaning, hey, here's your token, let's go, right? So when we talk about the underwriting of mortgage assets, when we talk about the actual front end manufacturing of mortgage assets, that's an area where we're investing heavily, where there's a lot of opportunity for throughput, right? So if I think about a typical mortgage loan right now or a mortgage underwriter, they might take time to do 2 loans a day, right? With Blue Water technology, they can do 10. Right? Now think about that throughput, right? So your point's very well taken. My gosh, it's sticky. It takes time, right? It's very cumbersome. Point well taken. At the end of the day, right, we see thousands of loans a day through our platform, right? We're the largest private entity in terms of trading, our various mortgage assets. What we're able to do through this technology is deliver, to your point, after all of that, right? A very streamlined, good delivery loan file, going back to this concept of trust.
Okay, so it's more after the initial, it's you make sure it's digital from start to finish, but all the process I described is still there. It's just if the bank that did the initial mortgage wants to trade it or give it to someone else, that whole trail is digitized and the trading of my existing mortgage is what would be faster and more efficient with your tech. Is that right?
Absolutely. And I think as Tal was saying, right, in 15 years, those who are efficient will still be part of this conversation. Those who are inefficient will likely not be, right? Because what's the limiting form? The limiting form is better margins, more efficiency, and scale, right? That was one of the other things I wrote down as Tal was talking was, quite frankly, we need trust, right? We need good delivery, and then scale, right? Can we move assets through the front door, right? And can we do it in a meaningful way that's broad enough, right? Certainly from where we sit, we see it. It depends on what the asset is. Like to your point, again, to dovetail off of Tal, offering bills out, right? T-bills, like that's great. We can do scale, we can do size, but unless we're sort of worried about, unless we're trying to solve like a currency sort of transaction, right? It really comes down to what does the return look like and what problem are we trying to solve, right? Who's our end buyer, right? Like there are only finitely many people that want bills vis-a-vis token. But if you can unlock mortgage assets, for instance, right, and you're going to talk to us about high yield, and if you can do that in a way that delivers all of those key elements, trust, scale, et cetera, where we're starting to get is we're solving problems for investors who want access to assets that they otherwise can't get the same way for whatever reason. They can't trust it. They don't know what the delivery standards are. It's at a different return target than what they're looking for. And so I think it's a number of these different things that we simultaneously have to solve for on both sides of the coin. I'd love to hear your thoughts with regard to high yield. Scott, I don't want to dominate the conversation.
Yeah, no, I mean, I definitely think that the exchanging of mortgage assets and trying to create efficiencies by having a standardized process and, an open platform that anyone can participate in. And, that will definitely add, some efficiencies to the secondary market of, borrowing and getting leverage against these mortgage positions that somebody has. My background is in ABS, and I think a lot about from start to finish, having the loan origination on chain, the loan repayment in USDC, when I was working at Deutsche back in the days, we'd have I get a spreadsheet of 10,000 consumer loans, and, the whole process of one person repaying their loan to that dollar flowing through to the end bondholder, that charges, let's say, maybe 50 basis points throughout that process, perhaps. And, on a multi-trillion-dollar market, that can be really meaningful. And, that's kind of, I definitely agree that the, starting the process digitally native is, a good direction to go.
While we're on this, Scott, why don't you just tell us, how does so you mentioned how, this would enhance, lending and borrowing. What does HiYield do? How does it work? What you guys are doing in lending and borrowing? So I want to know, how blockchain enhances it, and where you see lending and borrowing going in the next 5 to 10 years based on what you're doing.
Sure. Yeah. I mean, for those familiar, you could think of the high yield infrastructure as an on-chain repo facility. So, we kind of allow individual lenders to create, custom parameters and bespoke lending facilities for their partners in a scalable way. So if they want to provide on-chain repo against treasuries, they could just kind of set the parameters once, and anybody who has, tokenized treasury that matches this type of, whatever these parameters, they can get, they could borrow against their position for, short-term financing. And I do think this is one piece of, broader on-chain capital markets infrastructure that, the way I think about this is kind of starting one step at a time, proving out the technology, showing that there are genuine efficiencies in one transaction type, and then starting to apply that on a larger scale. And I do think repo, for example, is a really good use case considering, JP's, I was just reading a report the other day. I don't know when the report actually came out. I think it was maybe late 2022 on Onyx, JP Morgan's private blockchain. And, they've been settling, they settled over 400 billion worth of repo transactions across the banks involved in the, in Onyx. So I do think that's a good place to start. And we're seeing that with traditional financial institutions as well.
Thing. Yeah, we saw Broadridge as well. We've seen, $1 million, I believe, in savings for every 100,000 transactions. That I'm sure can add up quickly. So right. Again, we're seeing some numbers finally come out, something that we didn't see necessarily in the last 5 years, or maybe, a little less, but we didn't really see some data, tangible examples of hey, what is blockchain really doing for us here? It's something that we're starting to see a lot more this year. I like to think of 2023 as a transitional year. We had the crypto era, the NFT era. 2023 to me was a transitional year into tokenization. It's what people are talking about nowadays, finally. And so 2024, I'm hoping is going to be huge for tokenization. But that being said, we've talked about those examples. Are there any other examples that you guys want to talk about, in terms of use cases that you're working on? I know that HiYield, you guys have some exciting news coming out with Avalanche Vista. Can touch on a little bit on that as well.
Sure. Yeah. I mean, definitely excited to be building in the Avalanche ecosystem. I think they're clearly aligned with the RWA narrative. I mean, they commissioned a research piece on the block. They help a lot on kind of the business development side and just doing research to see where demand is in this market for like these types of products and people interested in piloting new technologies. So that's been super helpful. And then I guess more broadly, just like on the, direction or like the other examples of tokenization, it's not necessarily something that I'm looking into specifically with HiYield, but I do think like markets that don't have good existing infrastructure could be good places to target for, I guess, loans for high yield or just broadly like tokenization. I'm talking about like art, for example. I'm not an art connoisseur. I'm not like super involved in that space, but I was chatting with a few others about, how like the issue with tokenizing existing securities is that you kind of have this like double ledger system. They have this like existing infrastructure that you need to comply with. And then you're also trying to move settlement and other types of transactions on chain. You kind of have to mirror both in both infrastructure, but in the art space. And, I am looking at other space as well, just kind of, looking further out and, where the next pocket of demand and pocket of efficiencies can be. I do think that, looking at areas without existing infrastructure that you have to mirror, that you could just come in and bring efficiencies to like transparency, history, and transaction settlement is a good place for people like builders in the space to work towards.
Fantastic.
With Scott, one of the interesting domains I've seen over the last couple of years is supply chain. Supply is really mirroring the same story that you just described, Scott, without the regulatory existing system and set of rules, and a tremendous amount of inefficiencies because the supply chain, even when it's digital, it's really mimicking a paper process, and there are tremendous amounts of efficiency to create there, and many players are doing that. That's very interesting. I think we're going to see a bunch in healthcare as well, although it's a very slow to adopt industry. But there's some very hairy problems that the industry has been trying to solve since the 90s that I think blockchain can offer some very unique solutions as an infrastructure.
Nice. Yeah, I'd definitely be curious to hear if you know of like anyone building in that direction, just to kind of read about it from a research perspective.
Yeah.
Generally, the concept of being able to buy and sell receivables, however they manifest, right? Whether it's healthcare or factoring vis-a-vis logistics, I think that's obviously very interesting. Again, I'm very self-interestedly going to talk about, talk to my position, and that position is just the fact that, listen, at the end of the day, the U.S. mortgage market is ripe for this sort of activity. We've been focused on MSR, but coming down the pike are whole loans, coming down the pike are non-QM products. And listen, at the end of the day, the average end investor doesn't have access nor scale to be able to get access to these assets. Tokenization creates that natural segue. Again, we have to figure out what problem are we trying to solve for them? At what return? How do we enforce trust, right? How do we do it in a way that makes it interesting with scale, as Tal was saying? We feel like we've solved a lot of those problems. There are others. I think there was a question on that. But it comes back to, it's a chicken and egg, right? Part of the reason that we're not here already is you need a number of the key infrastructure solutions in place. We spent years building it. We're here. We're ready. We're chain ready. My expectation is both Tal and Scott, with regard to what they do, are chain ready. But it really has been heretofore a chicken and egg concept. And we got the chicken and we got the egg. Does that make any sense?
I love this. I actually really like that, how it segues into one of my final questions, I guess. We do have 5 minutes left, by the way. I do want to thank our sponsor, Oasis Pro, our title sponsor here, as well as Red Swan and Venium, and others that have made this event possible. But with 5 minutes left, I do want to hear each of your perspectives into, any predictions that you want to share for the next 5 to 10 years in terms of tokenization or blockchain technology in general for the capital markets. And specifically, the question I wanted to ask asked was, who's going to make this happen and bring it to the next level? Is it the fintechs or the incumbents?
I think I already answered this on the Q&A text, but I think both. It's actually very interesting because the way it started was new players and bottom up, right? And this was a very hard work of trying to roll a big rock up a mountain. But over the last 3 years, we've seen many of the incumbents seriously getting into this and not just investing money, but doing serious stuff with tokenization, starting from the really hard areas of settlement and so on, and then moving to making things more accessible to investors. And I think the answer is very much like Alan said it before. The ones that will adopt the technology will win, and the ones that won't will not be here. Some of them will be incumbents. There's some very innovative incumbents that are playing. We see what's in front of our eyes in the US, and we know some of the players that are doing this. Some of them are huge. BlackRock is there. Fidelity is there, HSBC is there. There are a bunch of others. Bank of America is there. But in Japan, most of the capital market players are kind of very deep into this already. So those that are going to take advantage of the technology will be here and will make it all happen. Some of them are going to be new players. Some of them are going to be old big players, and it's going to move both top down and bottom up and meet somewhere in the middle. I think it's going to be a very interesting process. And I think it's also important to recognize this is going to take 10, 15 years. This is not happening next year. We'll see steps and steps and steps. And part of this is also the regulatory framework, right? I think the US has been very fortunate that the SEC moved very early in 2019 and said, digital securities are securities, everything applies, go play. And that made things much easier in the digital security space than in any other blockchain-related space, but there's still the duality where the SEC wants to see everything settled the old way, even if it's on the blockchain. I think the day is not very far where the SEC, because of a lot of main market players coming into this, very big traditional players coming into this, will recognize that regulation can change and adapt to blockchain as a standard and will allow the settlement to happen in a natural way, and you won't have to have the duality anymore. So we'll see that as well. But again, I mean, these will, when they happen, it'll be a big step forward, and we'll see much more happening, and we'll see more players joining into this and more standardization. But it's a 10, 15-year process. The nugget is that at the end of this 10, 15-year process, you see well over $100 trillion of assets on blockchain. So it's very, very worthwhile staying for the duration.
Absolutely. Well, 1 minute left. Alan, Scott, any last minute thoughts before we hop on to our next panel?
I'll just echo what Tal said here. Saying that both fintechs and large financial institutions, I agree, will have their kind of place and their niche in the future of capital markets, and that absolutely, all capital markets transactions. I'm looking forward to ending that duality, however long that takes. You've already seen it in Europe, I believe, Swiss DLT. Legislation recognizes blockchain-based transactions as legally binding. You don't need this duality of managing both systems. So I'm looking forward to that day coming, and for HiYield being well positioned when it does.
Thanks, gentlemen.
All righty. Well, thank you, everyone. I appreciate your time, and all three of you for shining, your insights upon all of us, and getting to learn about, what each of you is doing, what you guys see this market going in the next few years. And I think it's a bright future for all of us. So with that, we're going to close it out. Please join us on the next panel for the RWA blockchain adoption. All right. Thank you all.